All right, well, what I'm talking about today is obviously shown on the topic there. How does monetary policy work and how do banks work? And this, of course, is a topic which it turns up forever in both economic theory and also economic policy. So if you think about what you talk always about what's the central bank going to do and why aren't banks lending money and why did banks lend too much money, etc., etc. So they're all extremely common topics. Now, if you look at the mainstream, you know I've divided the mainstream into two groups. The extreme believers in the model, who they call themselves they are called freshwater economists. The slightly less extreme believers in the mainstream model who take perfect competition but say there's also imperfect competition and therefore markets don't work perfectly and therefore there's reason for why the market system needs to be nudged occasionally by the government. Those are your two fundamental groups. And they both believe that if you ask them how banks operate, they'll tell you banks are intermediaries. They say banks, I call this the Ashley-Madison theory of banking. Now, does anybody here know what I mean by Ashley-Madison? You're a bit too young. Okay. It's an introduction agency for people who are married who want to do something with somebody else who's married to somebody who's not them. Okay, and they charge a fee for the service. Okay. Introduction agents, a bit. Anybody belong? I did once. Anybody who belonged to a singles group on the web? Okay. For those who've already committed themselves to marriage but don't want to stay all that committed. That's the Ashley-Madison theory of banking. So banks in this model don't actually lend money. Their own money. They don't create money. They don't lend money. They take in money from borrowers and they then, from savers rather, people who save money put their money in a bank. The bank then lends that money out to people who are borrowers. Savers are normally seen as being households. Borrowers are normally seen as being firms, but that got a bit confused during the subprime bubble in America when so much household borrowing occurred. But that's the basic idea. And then the savers, the higher the interest rate, the more people are willing to save. The lower the interest rate, the more people are willing to borrow. And that's the sort of vision they have of it. And a guy called Paul Krugman, whom I presume you've heard of, is the most aggressive pusher of that particular theory. So I've linked, if you click on this link here, you'll go to one of his many blog posts on the topic. And here he's having a go at an English historian called Niall Ferguson. But he explains how he thinks the model works. And that'll be the best way for you to find out what's actually meant if you're doing a topic that covers those sorts of ideas. So they see that's how they think banks work. And now in terms of how they think conventional monetary policy works, what they believe is, well, the higher the interest rate, the more people want to save money. Okay, so you encourage people who are hanging on to cash, and cash isn't giving them any return, so they've got that folding stuff in their pockets or coins and so on. And a higher interest rate means the deposit is being offered a higher rate means they're more willing to forego consumption now and put those savings into a bank where the money bank will lend out the money to borrowers. On the other hand, the high interest rate discourages savers because the higher the interest rate that a borrower has to pay to get funds for a project, the more they have to discount the returns they expect to get from that project over time, and therefore the lower value they get, which means it makes projects less desirable. So higher interest rate encourages supply, reduces demand, brings the two into equilibrium, that sort of idea. Now, of course, at the moment they're not just practicing conventional monetary policy, which is all about manipulating the interest rate to try to control the level of economic activity. They're also pumping money into the banks by what they call quantitative easing. You've all heard of that? Okay. And what that means with quantitative easing, they buy bonds off banks and in some cases non-bank financial institutions. And that is, they have several reasons why they think that works. One is they have a model which they call the money multiplier model, which says banks actually do create money, but they create it by taking in deposits from savers or getting extra reserves from the central bank. They therefore have more reserves than they need. They lend out the excess, hang on to a bit, and by a process of iteration, the entire banking system creates money. That's their little model there. So they think that by buying bonds off the banks, when they buy the bonds off the banks, they give banks more cash, because when the bank sells the bonds, the private banks own government bonds, and they're an asset that they make money out of. Okay? than the interest rate that's paid on government bonds. So the central bank buys those bonds off the banks. The banks have less bonds, so they're making less money because they've got less bonds to earn interest from, and they've got an equal increase in the amount of cash they've got, which is excess reserves. So the theory they have is with the excess reserves, they will then lend them out to the public, and that will cause much, much more money to circulate. That will stimulate the economy. That's one idea they have. They also, quantitative easing isn't just buying bonds, it's buying both government bonds, which is normally all they do buy with conventional policy, but also bonds issued by banks themselves, what are called mortgage-backed securities or things like that. So they're buying both government bonds and non-government bonds, which they never used to do before, the latter. They never used to buy non-government bonds. And they're also buying them across a whole range of maturities. So a bond will have a date on which it falls due. And you can buy bonds, government bonds, and even private bonds, which have maturities as low as 3 months. So you might, for example, if you buy a bond with a 3-month maturity, you might buy a bond which has got a face value of £100, and you pay £99 to buy it, and in 3 months' time, you give the bond back to this issuer, and they give you £100. Okay? So you get a £1 interest over 3 months, which is pretty reasonable. It's about 4% a year. That's the short term. At the other extreme, you can buy bonds with a maturity of 30 years. And there are even bonds which are called consols, which are eternal. They never expire. So when you buy a bond like say £1,000 government bond, they can do it in one of two ways. You might buy it for say £50, and many years in the future they give you 100. Okay? Or you might buy it for £100 now, and for many years they'll pay you 2% or 3% interest, and then they'll buy it back off you for £100 at the end. That's how bonds work. So there's a huge range, what they call I've forgotten the term all of a sudden. I'm giving the lecture. I'm forgetting words these days. But they have what they call a term structure. Okay, short 3 months, very not so short 1 year, 3 year, 5 year, 15 year, 25 year. That's what they call the term structure. So normally the central bank just buys the very short term ones because they're trying to affect the short term interest rate. With the unconventional monetary policy, they buy them right out to 30-year bonds. Okay, so what they're trying to do is bring down interest rates from very short maturity bonds to very long maturity bonds. So that's what they're doing with it. Now, actually, that does happen. I've said I make a strong statement at the end of this slide, but that actual belief of what they're doing, that does seem to work because they're buying bonds all the way across the spectrum. If you buy bonds, you make the bond price go up, you therefore drive the interest rate down. Okay? You understand that mechanism? That's the basic logic of by buying bonds, you make the bonds more expensive. So like a bond, the bonds buy and sell on the market. So you might have a bond which was issued for £100, okay, and it was returning say 2% interest. And then if you buy so many bonds, you drive the price up to £101, that it's making £2 interest on £101, which is less than £2 on 100. Okay, so rising price means falling interest rate. That's the logic of buying and selling bonds. Now, that's the overall perspective they've got. As I said, this particular point, this one here, that's true. Not particularly effective, mind you, but that does seem to work to some extent. Now, everything they believe is wrong. Okay? I'm going to take you through why that's the case in today's lecture. So if you look at economic policy before the financial crisis in 2008, it had been reduced fundamentally just to monetary policy because, as I mentioned in the last line of that, second last line of that last slide, they didn't believe fiscal policy was good or worked. They had what's called Ricardian equivalence. If you look that up, it argues that if the government spends now, people in the private sector spend less, and therefore one cancels the other out. So they saw fiscal policy as being ineffective. And the policy rule they used, and I showed you about this last week, is called the Taylor rule. And that was a rule that said, effectively, if the economy is not working at full capacity, and if inflation is lower than we want, we've got to drop interest rates. But if the economy is working at or even above capacity, and inflation is high, we increase interest rates. That's pretty much the Taylor rule. Now, there were three core parts to the models they used that decided this, and again I showed you some of this last week. They had the idea of the household sector, and the household sector had to choose between working now or having leisure now. Okay, so either you work or you relax. And you're making a decision that gives you the most utility you can get forever. Okay, you're working out what's the optimum amount of relaxation I work now and tomorrow and a year later and 10 years later and 60 years later, etc., etc. Then you have firms which are trying to make a profit, but they're trying to make a profit where they get the maximum profit they can for eternity. So they're working out what to sell now and tomorrow and the day after, so that if they calculate the rate of return they get over time, they get the maximum rate of return forever. And then the central banks in the model as well, and this is the unusual thing about these models compared to previous mainstream models, they include the central bank in the model. And the central bank is manipulating the interest rate to try to keep inflation and unemployment at the levels they want. And they discourage fiscal policy because they thought it was being ineffective. Now, that belief, and I showed you a bit of this last week as well, began with Friedman critiquing policymakers trying to exploit what's called the Phillips Curve, which was the argument, again I showed you how that was derived, by a non-orthodox engineer turned economist called Bill Phillips. He implied at one point there was a trade-off between inflation and unemployment. You had a menu choice. Now, the fact that that menu choice appeared to break down in the late 60s, early 70s, led to what's called rational expectations economics, where they assume basically everybody can predict the future accurately because we're all rational, and doesn't rational mean the capacity to predict the future accurately? Of course it doesn't, but that's how they use the word. And that belief was shared by both the mainstream and by both saltwater and freshwater. So the way this was expressed by the first person who dreamt this piece of nonsense up, and it's nonsense, was to say there's no. Well, these weren't the ones who dreamt it up. They applied it later. They said there's no way in which there can be counter-cyclical policy. So the government can't spend more during a slump and boost the economy, and spend less during a boom and stabilise the economy. So the government can't do that, because if it's going to do that, it's got to trick the public. And according to the assumption that expectations are rational, there is no way that that can be done. There's no possibility because everybody effectively, we're all rational. Rational means we know how the economy works. Okay? Because we know how the economy works, we know if the government does this, it'll have these consequences in the future. Therefore, we respond to that and say, ha, you're trying to fool us. No, you can't. Sorry, we're smarter than you are. So therefore, the authority cannot expect to exploit the Phillips Curve for even one period, meaning in their model, I think 3 months, or maybe in 1 year. People get Nobel Prizes for crap like this. So they combine the idea that there's a natural rate of unemployment. First of all, say the economy tends to some natural rate. And then secondly, people are rational, which means they can predict the future, given an economic model. We get the idea that there's no possibility of pursuing counter-cyclical government policy. That's published in the Journal of Monetary Economics. Okay? At least one of those guys got the Nobel Prize, Sargent, I think. Okay. Now, along comes 2008. And putting it mildly, they had no damn idea it was going to happen. And in fact, their models are predicting that there'd be tranquil growth. So here's the Organisation for Economic Cooperation and Development. I've just applied for the position of chief economist there. I'll see whether I get interviewed or not. And what they wrote in autumn, which is, they're saying in last autumn, so they're writing in June now, this is beginning of winter of 2007, so saying back in maybe March or thereabout 2006, they thought that the slowdown, which was obviously happening in America at the time in mid to late 2006, was not heralding a worldwide period of weakness. And recent developments, so talking June of 2007, mind you, confirm this hypothesis. Indeed, the current economic situation is in many ways better than we've experienced in years. Remember, the OECD is called the Rich Man's Economic Club. It has about 40 countries as members. They're all developed all developed economies. So South Korea's in there, Japan's in there, China's not in there yet, I believe. Australia, Canada, America, the UK, all of Europe, all of Western Europe, they're all in there. So this is the policy advice that's been given to politicians, governments in these wealthy countries. I said they've stuck to what they call a rebalancing scenario, and their forecasts were quite benign, they said. So imagine you go along to the doctor and say, am I ill, doctor? And they say, you've just got a cough, you haven't got lung cancer, don't worry about it, go home and, you don't need to worry about, keep on smoking, it's fine, you're not going to get lung cancer. So they predicted a soft landing in the United States, strong and sustained recovery in Europe, solid trajectory in Japan, buoyancy in China and India, and what they said to be strong job creation and falling unemployment. Okay? It's June 2007. Well, this is what actually happened. June 2007 is about there. And at that point, everything, a couple of months later, went spectacularly wrong for virtually all the major economies, including, by the way, a couple that appeared to get through it okay, Canada and Australia. But the US, the UK and the EU all had dramatic increases in unemployment. And you'll notice that even the Australian economy, which appeared to get out of it without a recession, they still had a dramatic increase in unemployment. The biggest you can see there in many ways is the USA. It went from an unemployment rate of below 5% to 10%. And that looks like it's a lower rate of unemployment than they had back in the 80s, but in fact they've redefined unemployment so much that if you look at the two definitions and make them comparable, the unemployment rate in 2008 was the highest America has had since the Great Depression. Okay? So it was spectacularly different to what they thought would happen there. That's the actual date they made the forecast. So again, on the analogy of cancer, it says, don't worry, go home, you've only got a cough, continue smoking cigarettes, 3 weeks later you die of lung cancer. Wasn't quite that severe, but unemployment doubled over the next 2 years. So a spectacularly bad forecast from mainstream models. Now their policy response, and I spoke to the guy who was George Bush's, who was president, still president at the time, he was president until I think I handed over January 20 of the year after the election. So Bush ceased being president in January 2009. So when this crisis began in August of 2007, the chief economist was an appointee by George Bush, and his name was Ed Lazaire. Very nice bloke, I have to say. Very nice guy. He told me that the state of mind when the panic crisis hit in the Bush cabinet was sheer panic. Okay? They had no idea this was going to happen. They were completely terrified by it. And the basic attitude they had was that capitalism was not going to fail on their watch. But they actually felt like if they did something really, really big, capitalism was going to fail, and they'd go down in history as the people who were in charge of capitalism when it collapsed. So what happened is, as soon as, because of the crisis itself, no deliberate decision necessary, tax revenue plunged. Many, many people lost their jobs. They stopped paying taxes. Company profits plunged. They stopped paying taxes. At the same time, welfare payments, unemployment payments, even though they're lousy in America, they still soared dramatically, and the budget went into a huge deficit. And if you take a look at the scale of the government surplus, this is looking at the percentage of government spending in excess of taxes. And if the government taxes more than it spends, you get a surplus. So this line here, just to zoom in and show you, that's when there's neither a surplus nor a deficit, that zero line. Now if you look along here, you can see if I come down to the dates down the bottom here, whoops, mouse skips are coming back to here. Okay, this period here, the 1920s, the government was running about a 1% of GDP surplus all the way through. Before the war, it ran pretty much balanced budget before the First World War. Then the First World War occurred, bang, of course they had to finance the First World War, so massive deficit, and government spending was 17.5%. Government spending greater than government taxation was 17.5% of GDP. Then you had this period where they thought they were being what they called practicing sound finance. So every year the government tried to run a surplus, and they succeeded for the whole of the 1920s, and it was roughly 1% of GDP. Then, oh dear, the Great Depression hit. Well, they fall to about a 5% of GDP deficit, and they stayed at 5%, looking down here, for most of the early 30s. Then, in the late 30s, when unemployment had fallen dramatically from the worst level of the Great Depression, economists, mainstream economists, of course, very, very different technical beliefs, but still the same sort of theory, they convinced Roosevelt, who was then the president, that he should return to surplus. So the government went from running a deficit of 5% of GDP, so spending each year 5% more of GDP in government spending than it got back in taxes. It went back to balanced budget. Unemployment, unexpectedly, I'm saying from the point of view of mainstream economists, unemployment, which had fallen from 26% in 1932, so about here, had fallen from 26% to 11% about here, rose back to 20% again. Roosevelt went back into a deficit, and then the Second World War began. And during the Second World War, government spending was often 25% higher than government tax revenue in terms of percentage of GDP. Then you had the post-war period, and you look at all these periods here. Now you see a few periods here where there's a surplus. There was a big surplus in the immediate aftermath to the war. Not a little one, not a little one, little one, little one, and then bang, all the way out here, deficits as far as the eye can see, until Bill Clinton became president. And one thing Bill Clinton prides himself on, apart from his taste in cigars, was that he got the government back into surplus again. And you saw a surplus much the same scale as at the beginning of the 1920s. Then the Iraq War comes along, so that was a particularly stupid piece of American policy. But to finance the Iraq War, they went back into deficit. That was without the Iraq War, they would still have been surplus at that stage. Started to return to it, and then the crisis hit, and they're back down. They hit down at one stage. That level there, as you can run across here, is 10% of GDP. So the scale of government spending during the immediate aftermath of the crisis in 2008, a crisis they did not expect, government spending was twice as big as a percentage of GDP as it was during what's called the New Deal. Okay, so have you all heard of the New Deal? Any history lessons at school? Okay. You know, that's when Roosevelt financed things like the electrification of Tennessee, building of the Hoover Dam. I think they started the construction of the roads across the country. Huge number of infrastructure projects just to get people working, because at the time they were doing it, the unemployment rate was 25% of the population. So 1 in 4 people did not have a job. Okay? So the government, huge spending back then. Even as big as that spending was, it's half the scale of what happened under Obama in the immediate aftermath of the crisis. So this huge scale of spending is a major reason, well, according to economic theory, it should have had no effect at all. Okay? But practically, that was a huge part of what caused the crisis to turn around. So you had, for a short period of time, government spending being 10% larger than government tax revenue in terms of percentage of GDP, versus a maximum of 5% during the New Deal. So that's the scale of what happened. Now, on top of the automatic stabilisers, so a drop in tax revenue, increase in government welfare payments, they also brought in a whole range of projects. One is called Cash for Clunkers. Have you heard of that? Okay. Clunkers is the American term for junky old cars. So you were given money, like $2,000, I think, to bring your car in and hand it in so it could get trashed, and you had to use the $2,000 towards buying a lower pollution car. Of course, under Donald Trump, they'd give you $2,000 to buy a bigger car. But still, under Obama, it was to get a car that reduced pollution. TARP, Troubled Assets Recovery Program, that was supposed to be $700 billion to the banks to get them over having damaged assets. I think it actually peaked out at about $2 trillion. Okay? A whole lot of stuff like that. And the whole emphasis of policy, and this is Obama's speech now, was to rescue the banks. Okay? That was seen as a major. Now, this is a brilliant piece of Obama speak. You know, have you ever hear Obama give a talk? You've heard Donald Trump, I imagine, with those huge words of his. Okay. Obama, for whatever else his sins were, was an extremely good orator. So here he says, and although there are a lot of Americans who understandably think that government money would be better spent going directly to families and businesses instead of banks, where's our bailout, they ask. He then says, the truth is that $1 of capital in a bank can actually result in $8 or $10 of loans, notice the word loans, I don't think Obama thought this through, to families and businesses, a multiplier effect that can ultimately lead to a faster rate of economic growth. That's straight textbook economics. Okay? Put more money in the banks, they've got more to lend out. Each dollar you put in the bank will become $10 of cash in the economy. Happens to involve loans, but we don't worry about that. And that will boost the economy. That was his theory. So the idea was that this huge boost to government, the money created by the government, which is called base money or high-powered money, that would solve the crisis. And this was, at the same time, the chairman of the Federal Reserve at this stage was Ben Bernanke. And this is how he explained the Great Depression. His theory was the Great Depression was caused by the Federal Reserve not doing what he recommended Obama do this time round. The Federal Reserve didn't expand the base money supply, and that, according to Ben Bernanke, is what caused the Great Depression. And he has a book called Essays on the Great Depression, and that was effectively his job application for chairman of the Federal Reserve, because he made his specialty trying to explain what was an anomaly to mainstream economics, which was this Great Depression. Okay? And so his theory was that there was a huge fall in aggregate demand. He said that had to be the case. Somehow aggregate demand fell really badly during the Great Depression, and it appears it was caused by a worldwide contraction of money supplies, and this was due to a poorly managed and technically flawed monetary system, which was the gold standard. But he also criticises the organisation that he was applying to be the boss of, and said that the monetary data for the United States underscore the stinging critique of the Fed's policy choices. So this is a book by Milton Friedman and Anna Schwartz, which is the main claim to fame that Friedman had as an academic economist. He said the United States is the only country where discretionary policy was destabilising. So what they had a choice about doing made things worse. And what he said is the ratio of monetary base. So monetary base fell for those periods of time from 1928 June through to 1931, and that meant that there was a contraction in the money supply when given that international flow should have expanded the money supply. So he said nominal money growth was precisely zero between the fourth quarter of 28 and 29, despite inflows of gold and the money multiplier being increased, so the ratio of money creation by banks being raised. And 1930 was even worse. Nominal money fell 6%, even though the gold supply increased by 8%. So he's blaming the Federal Reserve for this. And he said the cause of the decline was a contraction in the ratio of base to reserves, okay, which reinforced falls in the money multiplier, which is a measured amount that was already increasing. He said so much of the blame of the early slowdown is due to the Federal Reserve. Well, guess what? He gets the job of being chairman of the Federal Reserve, and the same thing happens all over again. Okay? So how did he react? Well, he took his theory seriously, and he took it seriously after the crisis hit because, funnily enough, even though he wrote this sort of stuff, he was ignoring it in his own policy, because if you take a look at the data, much the same thing happened under his control before the crisis began. There was a fall in base money and a fall in the money multiplier happening while he was the boss, which he seemed to ignore. But then what he did when the crisis hit, he had an incredible increase in the money supply. Watch this. Okay? That's the amount of base money. So what you can see is flatlining, this is in straight dollar terms, becoming visible now because of inflation. And then the crisis hits, bang, 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 bang. That's all discretionary policy. So in a matter of just a bit over a year, he increased the amount of base money from about $800 billion to $4 trillion. So a five-fold increase, okay, in the amount of money, in the base money in the economy as a policy response. So this is the scale of things that were being done. Fiscal policy, deficit of 10% of GDP, twice what happened during the Great Depression. Monetary policy, five-fold increase in the amount of money. And when you look at the percentage of GDP, it's still stark. So you can see as a percentage of GDP, it reached a peak during the Second World War. Then it pretty much fell all the way through until the 1990s, and then it was rising a bit. And this is roughly when Ben Bernanke was chairman. Across this period, despite his own theories, which blamed base money falling compared to the amount of money in the economy, despite his theories, he let it fall. Then the crisis hit, oh dear, bang, and up to a level which is higher than ever in the history of America. Dramatic increase in base money, that's reserves, okay? The reserves that private banks have. Now, much the same thing happened in the UK. Okay, so you went from 40,000 million pounds, so 40 billion pounds, to 400,000. So a tenfold increase. So this is the scale of the policy that was going on when you guys were back in primary school. Okay? Looking at that as a percentage of GDP, very interesting pattern for the UK. Again, the same sort of story. From 1870 through to the beginning of the Second World War, it was generally 10% to 12.5% of GDP. So base money was quite a large fraction of GDP. It rose spectacularly during the Second World War, though not as much as in America. Then it uniformly declined until just before the crisis, when bang. So that's the scale of actions that were on there, huge. Now the rationale they had for the increase was to increase the economy by the multiplier effect, and I've shown that was actually part of Obama's own speech. And it's based on a textbook model. If you get a macro textbook, this is what you'll read in it. Okay, read it when you read the cartoons, because the cartoons are supposed to be funny. Okay? And the idea is you add reserves to a private bank's accounts of the Federal Reserve. So just like you've got bank accounts at a private bank, the banks have a bank account at the central bank. So you add money to that account, and banks are then supposed to lend out a multiple of this. And because they lend it out to the economy, there's more money, and that's supposed to stimulate the economy. And here's a standard example from a textbook. So you add reserves to the banking system, and the first bank that gets it might say, hold, what they have, you might put £100 in, and the first bank hands on to £20 and lends out 80. Okay? And then the person who borrows the £80 takes that £80 to another bank, deposits £80, and the bank hangs on to 16 and lends out 64. And you keep on going like that, and what happens is, now I haven't shown this, if I make this any larger, let's see. That will take you to the actual textbook there to take a look at it. But if we just zoom in a bit, it's trying to show the balance sheet of a particular bank, the balance sheet of a second bank, the balance sheet of a third bank, as this process of one bank getting one bank getting excess reserves, lending to somebody in the public who deposits in another bank that lends to somebody else in the public, and on you go. And what they show is you start with, say, cash of 20 and deposits of 80. So there's $100 of money in total, and then you get a bit more cash and a bit more reserves at the next bank, and on you go. And over time, with this example as it's worked out in this textbook, you end up with 3.57 times as much money being created as was injected into the system. Okay, it's a fairly complicated example, but you can click on that and see what the logic is. So that's the idea about how you create money. But what actually happened to the money multiplier? Okay, this is the ratio of broader defined money, like M1 in this case. And M1 is basically cheque accounts and some savings accounts. Okay, that plunged. There's the crisis, and the ratio was about 1.8. Virtually overnight it goes below 1. And ever since then, it's just started to rise above 1 again. So there's a bit of a trick here, by the way. M0 are reserves. Okay, that's accounts that the private banks have at the central bank, cash and gold and all that sort of stuff. That is not counted in M1. So M1 is what's in cheque accounts and some savings accounts and so on. So the ratio can be less than 1 between the two. You're not adding to each other. What you find is the ratio got almost as low as 0.7. So there was more base money in reserves than there was money in cheque accounts. And that's not supposed to happen. If you look right back in the 1960s, the ratio of money in cheque accounts to base money in reserves was over 3. And it's been falling ever since. But it absolutely plunged during the crisis. And what they hoped was this would multiply, but in fact it's dividing, it's reducing. So something that's seriously wrong at that stage. Now, when you look at the one beauty of the age you guys live in is that the sort of information I'm about to show you now you could not find it when I was a student. Okay? It simply wasn't publicly available. You might be able to find stuff from 50 years earlier, but the Federal Reserve now publishes the minutes which precisely record the conversations they had both in the Board of Governors and what's called the Open Monetary Policy Committee, the OMC. So this is Bernanke talking about it, and this is intriguing. Talking in 2009 when he's still doing it, saying some observers are concerned that'll be printing money and that'll cause inflation. He said there's been a large increase in excess reserves held by the banks. Okay? And that's the narrowest definition, and that's risen significantly. He said, but, now notice what he says here. Banks are choosing to leave the great bulk of excess reserves idle on deposit with the Fed. They're not lending them out. So he's criticising the banks for not lending their reserves here. It's the banks are making a choice, and it's a bad choice. That's what he's saying there. Now, I love this. Reif Schneider, I think I got that right, who was a statistician for the Federal Reserve. He said part of the experience from Japan, because Japan had been through a similar crisis in 1990. And when they had that crisis, you think that if you put enough excess reserves, banks get too much, and they're going to lend them out. We've got too much in hand, we just don't want them, you're better off lending them out, he said. But it didn't happen. Okay? The experience is that it never happened. So if you go back a few months and look at what we're doing is, could it work this way? He says, we've learned a lot from Japan. It seems you can run up excess reserves to a tremendous amount and banks will just accept it. So this is now what they're doing is saying, we've provided the money, the banks aren't lending it, it's all the fault of the banks. Okay. This is Lacker, who was president of the Richmond Fed. He said, he's asking a question, said the usual prediction would be this amount of reserves would lead to an explosion in M2, broader money, including all savings accounts and lots of other forms of credit money. An explosion of lending, a burst of inflation. So they seriously believe the model they take in the textbooks. But what's happened instead, their holding of treasuries and so on have gone up by 200 billion. So it doesn't seem that we've caused a substitution of reserves for debt. Banks have just substantially, looks like they've tried to explain it. He's saying it looks like banks want to have more liquid reserves, a bit like you want to have more money in a bank account, that sort of thing. This explains why we aren't getting the money multiplier. That's in December of 2009. That's the sort of stuff that is now freely available. I think it's even about a 6-month lag now. They publish their minutes with a short lag in time. So if you actually want to do serious research into what they believe, you can find their information that way. Now, even though it hadn't worked in Japan and it hadn't worked in America, and they were complaining that it hadn't worked, the Fed was still worried there'd be runaway inflation. This is a fairly conservative member of the board, Charles Plosser, and he's saying, I think it'd be prudent for us to recognise that recovery, now he's talking in December 2009, the recovery may be more robust than we expected, and that there may be an increase in the real rate of interest faster than we anticipate. If so, we'll need to be ready to signal that we've got to go back to being tight with monetary policy later on. As real rates rise, the opportunity cost to banks have of holding vast excess reserves may lead to a rapid increase in the money multiplier. So they think banks can suddenly start lending out much more money, and a conversion of excess reserves into loans or borrowed money. So this is all believing the textbook model you'll be learning as part of macro next year, probably learning a bit of it this year. President of the Dallas Federal Reserve. As long as we have trillions, and he's quite right, there were trillions of dollars of excess reserves, the funds rate and the rate on excess reserves are going to have to move together with the interest rate on excess reserves determining banks' willingness to lend out reserves. So they seriously believe the theory they teach you in the textbooks. And he's saying, I'm not really sure about how practical it is to have all this stuff and be able to present those spilling into the marketplace. So what they're confronting is a theory they had about money creation that said that putting an extra dollar in as reserves would cause $10 more loans. In fact, the dollar went in 50 cents worth of loans came out of anything, and it didn't stimulate the economy. Why did it fail? Well, it's a false model. It simply can't work. It's not how money is actually created. And this is a struggle that I've been going through to get this point through to politicians in particular, but to some extent conventional economists. And I'm not the only one by far. There's been about, seriously speaking, about 15 or 20 prominent academics who are not orthodox economists, non-mainstream economists. Richard Werner is one in the UK, Randall Wray in America, Stephanie Kelton, Michael Hudson. There's a whole range of people who've been trying to say your model's wrong, but we've been saying it as minority, not mainstream, not taken seriously by the media because we're not mainstream. And then the Bank of England wrote this paper in 2014. And this is extremely important, so as I'm going to be going through why this is the case in the second half of the lecture. The reality of how money is created today differs from the description found in some economics textbooks. Now, that word some should actually be all. I think I know one or two textbooks that don't have this model or say that it's wrong, non-orthodox textbooks. So rather than banks receiving deposits and lending them out, bank lending creates deposits. And in normal times, the central bank doesn't fix the amount of money, nor is central bank multiplied up into more loans and reserves. And before this came out, there was a research paper by the Federal Reserve itself with a fairly complicated title, but the punchline is important. Does the money multiplier exist? And they say, well, the simple textbook says that there's a causal relationship between how much bank reserves exist and how much money there is in the economy, and that has assumptions that there's a tight link between money and reserves, and the central bank controls the money supply. That's it. Using data, we have shown this model is implausible. And they say, therefore, changing the quantity of reserve balances is not likely to cause a rapid increase in lending. So that was in 2010. So the model fails, and the reason is, and I'll take a break after this slide and talk about it why in the next lecture, it's simply impossible. Banks cannot lend out reserves. It simply can't be done. Because what banks are doing effectively is accounting, and if they did lend out reserves, they take money out of the reserves and put it in your account, it actually violates accounting rules. Now, is anybody here doing accounting? Nobody? Okay. You have to understand double entry bookkeeping to know why that's the case. And I've learned double entry bookkeeping myself, inventing that software package I showed you called Minsky. So I'll take you through the basics of that after a 10-minute break. Okay? See you in 10 minutes. Alrighty, double entry bookkeeping. As I mentioned, I'm going to be explaining it to you now. So nobody's done accounting? Okay. Nobody kept books? Okay. It was first invented back in the 1500s, so there are records that imply it was actually used by the ancient Sumerians as well, so it goes back a long way. This is a very, very good book by another Australian academic about how it was invented and what was the consequences to some extent. And the essential idea is you're trying to keep track of financial transactions. And this is a way of making sure you record everything twice. So the second number operates as a check on the first. I'm going to show you a very simple idea about it, because it's much more complicated when you start working with a company's books and how do you classify various things and so on. But at the simplest idea, it simply is that if you say money comes out of one account and goes into another, and the two elements have to sum, so a mathematical operation on the rows must return 0. And that's your double entry, that's your check of the whole thing. And the essential idea is 3 types of accounts are distinguished. One is an asset, that's something which is a positive for you. That might be the monetary value of your house, or the monetary value of your car, or the monetary value of your bank account. Okay? There are liabilities, those are negatives. That's the amount of money on your credit card, or if you have a housing loan, that sort of thing. That's a negative for you. And the difference between the two is your net worth. So if you have your assets, let's say your assets are worth £10,000, and you have your liabilities, and they might be £6,000, and your equity is £4,000. And that's the idea. And it's called the fundamental law of accounting, a fundamental rule, something of that nature, as assets minus liabilities equals equity. So if I use initials for that, I'm going to have A minus L equals E. And if I then subtract A minus L and minus E, I get 0. Pardon me, that's a great thing to have on a video. It'll go up on YouTube shortly. That's the basic idea. Now, accountants use conventions where they call debits and credits. They don't use plus and minus. That's okay, but I find that very hard to understand. That's why accounting students have nervous breakdowns and things like that. I simply show any operation that increases an account as a plus and any operation that decreases an account as a minus. That's it. Quite simple. And I didn't write the code for this, but I invented the idea of a software package called Minsky, which I showed you a bit of last week. And I invented it specifically to be able to model this type of financial transfer. I didn't, by the way, at the time I invented it, realise the importance of double entry bookkeeping. Designing Minsky has taught me that. That's why I'm passing on to you now. And we're redesigning the program to make it do double entry bookkeeping more easily. So this again is saying what banks actually do. The paper I showed you earlier, part of it actually says whenever a bank makes a loan, it simultaneously creates a matching deposit. Okay? So one is the asset, the other is the liability from the bank's point of view, and it's the exact reverse from the borrower. The loan is an asset for the bank, and the money that it creates with the loan, which it must create, otherwise you wouldn't say, if a bank rang up and said, how about you owe us $1 million? We won't give you anything. What would you say? I hope you'd hang up the phone. Okay? But the bank says, here's $1 million, and by the way, you owe us $1 million. They're giving you a liability to them of $1 million, but they've also given you $1 million to play with. And from their point of view, they've got an asset, which is the loan you now agree to owe to them, and their liability is to put $1 million in their account. And if you go to the account tomorrow and say, I want that $1 million to run out, they've got to give it to you. Okay? So it's an asset and a liability at the same time to two different people in two different ways. And that's also, again, knocking the money multiplier model there. So that's what banks actually do. So when you look at it, and I've set up a table in Minsky now, and I'll take you through that live in a short moment. Here are the assets, which I'm showing black here because, you're in the black. Red for the equity, for the liability, that's the negative side, and gold for what's actually left over. That's your net worth. And if you see what happens when a bank lends, it doesn't actually lend money. This is why I'm calling it, you see the text I've got here, I'm saying create money and debt. Because when you lend something, you take money out of your pocket and you put it in somebody else's pocket. Okay, that's lending from one account to another. What a bank is doing here is creating a debt and simultaneously creating the money. So I'm calling it lend there. I might call it create in future just to make it more easily. So what I've got is a bank has two sorts of reserves in this very simple model. It has either assets, it has reserves at the central bank, or it has loans it's making to firms. Its liabilities are accounts owned by firms, accounts owned by workers, and its equity is its own worth, so I call that the bank. And notice what's happening in every one of these rows. Every operation, lend, assets go up, liabilities go up, pay interest, the bank account goes down, the account of the bank goes up. Here you have repayment, the deposit goes down, the loan goes down. Here's wages, Money in the firm's account goes down, money in the worker's account goes up. When workers consume, money goes across here. When bankers consume, money goes across there. Fairly easy to understand? Okay, simple little idea. So lending is increasing assets and liabilities simultaneously, while repayment decreases assets and liabilities. And this is something I myself took a long time to understand and accept. Just as creating a loan creates money, repaying a loan destroys money, in the sense that money is the sum of the amount of money, it's a sum of entries in bank accounts. Most of you don't use cash anymore to shop, do you? I keep on giving shops a heart attack when I pull out money to pay for something. I paid for a chiropractic adjustment this morning and they were in shock. They hadn't received money for weeks. So you all use bank accounts. You're transferring between bank accounts. Well, if you transfer between bank accounts, the money goes from one person's bank account to another person's bank account. There's no change in the amount of money. But if you pay off a debt, your account goes down. Nobody else's account goes up. Your liability for the bank, which is the loan, that also goes down. That is effectively destroying money. Okay? Destroying is a heavy word, but that's the basic idea. Now, notice all the rows sum to zero, and they must. So even the initial conditions there, that sums to zero. You have 50 in reserves, 950 in loans, so a total of 1,000 in assets. I've got 900 in the firm's account, 50 in the workers, and 50 in the bank, a total of 1,000. That's the liabilities in 950, so the gap between assets and liabilities is equity, and when I do that sum, A minus L minus E, that row sums to zero, and so do all the other rows. Now, if I don't get a zero there, I'm making a mistake. Okay, it's an accounting error, and that's what accountants actually do all the day, and that's when they pass exams, they've got to get that right. So lending is increasing assets and liabilities by creating money and debt at the same time. Repayment decreases assets and liabilities by reducing debt and money at the same time. Now, what happens when you try to lend out reserves? Well, lending out reserves is going to reduce assets, but lending increases assets. So put it together like this. I've got a question mark here. There is lend out reserves, a minus here. Okay, you're having a plus over here. No, you can't. It doesn't sum to zero anymore. A minus L minus E ends up being 2 times that lending, what you're showing there. It's simply wrong. I could put numbers in there as well. In fact, I might do that on another slide because I can just show numbers here rather than text. But that's clearly a mistake. So what economists think banks do actually involves an error in accounting. Banks can't do what economists think they can do. They cannot lend out reserves. The sum isn't zero. So the accounting is wrong. That's all it takes. Now, this is something I talked a bit about in methodology way back in the first couple of lectures. You look back, you'll see the arguments I gave you there saying you can't reduce a higher level science to applied lower level science. Okay? So I can't reduce economics to applied accounting. But you can't have an economics which is inconsistent with accounting. And that's what you've got here. Okay? The high level idea economics has a theory about money creation which cannot work at the bottom level. It's like having a theory of cell biology that says you can all breathe cyanide. Would anybody like to test that theory? No takers. Okay. Sorry, I'm being a bit extreme there. So the sum's wrong. That should be zero. It's not. See, lending out reserves literally implies a negative entry in the asset column. Well, that's got to be matched by a negative entry in the liabilities column as well. You can't have one minus and the other plus, as I've done the row here. That's all you need to know. Okay, now, if you know that, you know more than virtually everybody who's ever governed a central bank. Tragic, but true. That's how wrong it is. Now, I often get told, well, what if the bank lends in cash? Okay, well, that's meant the assets. See, if reserves reserves have 2 major components in that sense. They're bank account entries just like yours, but at the central bank. But there's also cash in the vault. If you go to a bank and ask for a cash withdrawal, the cash that's coming out is part of the reserve. So that goes down, and they deposit in another bank. Well, if this is the logic of that happening, shown across 2 banks, so I've got, I was seeing it from the point of view of the banking sector, and seeing it from the point of view of the firms. And what you have is the bank up here I've got the one bank lending from reserves. So its reserves go down and it automatically records an increase in its loans. Okay, so it's got minus lending of the reserves plus lending here. That's on the same side. That's valid. Okay, minus from a plus. Money goes from reserves to lending. But of course there's no money turning up over here for the firm. So what's happening? Well, the money must be turning up as cash. It lends from. So what happens is more the bank gets the firm gets an increase in its liabilities because it's accepting the loan, but in the return it gets cash in its account. Okay. Then what the bank does is, well, let's deposit that cash in another bank. So therefore its cash goes down and it puts the money into another bank, and I'm showing this up here. So it deposits cash in another bank. Well, this model here is of the banking sector. Okay. This is aggregating all the banks together into the banking sector. And I could break it down into two separate banks and show it, but it would take 3 tables. It would just be more complicated. So I'm putting it in one simple table to bring it together. But that's what the conventional model has. You lend out of reserves in cash, and then the person who gets the borrowed money puts it back into another bank. I've simply put the 2 rows together. Now what happens is the lending out of reserves cancels itself out. Okay? All the operation over here is the change in assets is lending minus repayment. Now it could be more elaborate with a second or third year class. I might build a more elaborate model and show that. But it shows the model makes no sense. So what the mainstream believes is simply wrong. That includes Paul Krugman. Hello, Paul. It's just insane that they continue believing a model which is simply literally wrong. Reserves play no role in lending. What reserves do is enable you to make transfers between banks. If you shop at one bank and somebody else shops at another, and the banks have to reconcile, as well as transfers between your 2 accounts, there are transfers between the bank's accounts. That's the role of reserves. They're used to settle accounts. I have personal knowledge of this because my father used to work on the settlement account of the Australia's central bank system. Didn't know how much I learned from Dad at the time, but I've certainly learned since. So the banks are not lending out of an account which they can run out of money. Whereas if you lend to somebody else, the amount you can lend is limited by how much is in your account. Okay? If somebody comes and says, look, I really need an extra $10 today, for lunch, you say, look, I've only got $5 in my account. Sorry, I can't give you 10. Banks don't face that limitation. Now the money multiplier in effect implies they do, because as they lend from reserves, the reserves fall, and ultimately they've got nothing left to lend. So that's making banks look like they're you and me, and they're not. They're very, very different. Banks create money by recording the borrower's debt as an asset, while it's simultaneously a liability for the borrower, of course, and they record the money of their liability while it's simultaneously an asset for the borrower. That's how banks actually work. And I can easily model that in Minsky, which is the program I showed you last week. So let's take a faster matter. Then imagine you've got 150 in reserves and 50 of each of those in the firm sector, the workers and the bank accounts. And then a bank creates loans and money, and firms pays interest on that debt, and the firm then repays the debt, which cancels the money. It hires workers, workers and bankers consume the output of the firm, etc., etc. That's what I'm showing you there. I've just shown you that a moment ago. Now in the whole operation, reserves aren't playing a role. Nothing happens in this column because I'm not looking at transfers between banks and I'm not looking at government spending, which would affect what's in the reserve column. So it plays no role at all. And once you've done that, I'll show you that in Minsky in a moment. Once you set it up, what Minsky creates is a bank icon on a canvas that you can do mathematics on, and it automatically generates the equations for you. Now, that table I showed you a moment ago generates these equations. You reckon you could write them by hand? I used to try to do that, and I used to make mistakes all the time. That's why I invented Minsky, so to do it automatically. So you don't need to worry about all this stuff. Okay? There's all the mathematics of flows between accounts which involve what are called differential equations. Minsky generates those for you automatically. All you have to define is this bit where you say what's consumption by bankers, what's consumption by workers, what's repayments, what's lending, what are wages, and so on. So I'm going to, if I do this with a simple model with just constants inside there, I think I've got the model turning up. Let's see. Yeah, hang on a sec. The one thing I've actually defined that might make obvious to you is we've got loans, the amount of interest payments by the firms are equal to the rate of interest on loans multiplied by loans. Nice simple equation, okay? Now that's an obvious definition. Now, other things that I'm going to do in a more complicated model, I need to make a model where everything depends on everything else. That's when you're modeling a dynamic model, that's what you're doing. And you cannot do that with the supply and demand diagrams you get in a textbook. That's why I don't use textbooks, why in general Kingston has done without them. But you can model this using simulation software. So the obvious one I've shown you is interest payments depend upon the rate of interest and the amount of outstanding debt. And that's the simple equation there. And what's actually going on there, that multiply symbol is actually multiplies two numbers together. So it says the interest payments, which in this case are $2.36, are the loan, which is $58.90. Pardon me using dollars, but that's the way I grew up. Multiplied by a rate of interest, and that says 40 by 10 to the minus 3. Now 40 by 10 to the minus 3 is 0.04. That's what's called scientific notation. We're just using that because trying to scram a whole lot of big numbers there would be messy, so I've just used that as a little convention. So it looks a bit confusing, but I'll show you what it looks like, etc., etc. Now what I do in general when I model this sort of stuff is I could say, well, there's a rate at which workers spend their money. You have a certain amount of money in your bank account. Let's say you've got £100 in your bank account. I would say, what do you spend over a year? The answer might be £2,000. Well, effectively, the amount of money in your account turns up 20 times a year. Okay? So I could have the amount of money in your account at any particular point in time, £100, times 20 equals the amount of money you spend in a year, which is £2,000. Now, equally, I can do it the other way around and say, well, at the rate you're spending, if you didn't get any more money into your bank account, how long would you go before your bank account ran down to zero? And now, if the answer is that you turn your money over 20 times a year, then you divide a year by 20 and find out how many weeks you could survive before your bank account ran into zero, to be roughly 2 weeks. Is roughly 0.05 of a year. Okay? So I can either multiply by 20 or divide by 0.05. It's got exactly the same impact. I divide by 0.05 because you look at it and says, well, that's 1/20th of a year. What that's saying is if you didn't get any more money coming in, within 1/20th of a year you'd have no money left. And I can vary the numbers that way. That's the sort of use that I use. So that's the sort of basic idea there. Now what about bankers? How do you reckon long they could spend money from their account without running out of cash? I'll give you a little anecdote on that front. When I first came to the UK, I met a colleague who I knew through Twitter, who was in banking. His wife came along for the meal, and I'd never met her, so I asked her, what do you do? And she said, well, I'm a school teacher, but I used to be a banker. And I said, well, why did you change? She said, I got sick of the stress of banking, and I thought I'd do something less stressful. I burst out laughing, because I knew how stressful school teaching was. And she said, on top of that, when I got my first paycheck as a school teacher, not including my bonus, which she's talking about her previous job as a banker, it was 1/30th what I earned as a banker. Now, a first year out school teacher learns about £25,000, so what she was telling me is her salary was £750,000 a year. Okay? Roughly. Plus a bonus would probably double it, so £1.5 million a year. I imagine she had enough money in the bank account to survive a couple of years without needing any more money coming in. Okay? In fact, I know quite a few bankers who've taken what they call sabbatical. They've worked for a while for a firm, they've got sick of it, they've gone off and done study or travel for a few years, then they look for another job. So I reckon I could use a number like 2 or 3 for a banker to show how long they spend for. And then GDP, what I have GDP is I've got the firms inside there. How often do they turn over their money? That's the value of nominal GDP. And I might say, like a rough example, let's imagine that the firms turn over the amount of money they've got 4 times a year. Well, that'll be 1/4 of a year, they turn it over once, so 0.025 is what I'll use. So that's the basic idea. Now, once I do that, I get to a model that looks like this. And I'm going to try to make it build live in front of you now, which I'm bound to make a mistake, okay? But what I'll get is a model that behaves like this one here. So let's just bring up Minsky. And I'm using the beta version because we've made a number of serious improvements to the program, but we haven't yet got all the bugs, not all the bugs, you never get all the bugs out of something, but I'll try to do it without bugs as easy as I can. So what you do is you click on the bank icon, it's attached to the mouse, click again, and it stays there. I'm just going to redraw the screen because that symbol over there shouldn't be there. I've got to show that to Russell later. Now once I've done that, I right click or I double click and I can choose Open Godly Table. I'll just show you that by zooming in there. And I call these tables Godly Tables in honour of Win Godly, who's the first person who really developed this idea. And then what I get, again, it's a bit small to see it. Whoops, pardon me. We're going to make them pop up in separate windows. Oh, okay. What's called the focus keeps on changing. I'll just make it larger so you can see it larger here. This is one thing you couldn't do with the previous version. You can make the window larger. Hang on. So what I'm going to say is, well, let's talk about assets. So you're going to have reserves, which won't play any role in this model. If I click on the plus key, I create another asset column. I'll call this loans. And if I type the underscore, that's like it says lowercase, please. The next, I'll go subscript the next letter. Loans F. I'll move this sideways so you can see what's happening to the bank icon up there. Notice it's now got reserves and loans turning up over there. And then liabilities, I'll type firms. Add another column. Call this workers. Notice the bank icon has grown. And I'll just drag that out a bit. Now I've got the equity for the bank. I'll call that bank, meaning that's what the bank's net worth is. Having done that, click down here. Notice all those 5 elements have now turned up coming out the bottom of the banking icon. Okay. That's the initial conditions. So I won't worry about reserves. I'll leave them at 0. Let's say I have loans of 2. Actually, I'll just check and see what I had on the slide here. What did I use? I'll bring up this one, which is a finished model, in case anything goes wrong. That's what I want to get to. So I had 100 in loans, and I had 95 in the firm, 2 in the workers, and 3 in the equity for the bank. Okay, let's try that. So I go here, so I'm going to have 100, and then have 95 in the firm, and 2 in the workers, and 3 in the bank, which is a fairly highly levered bank, but that's okay. So there's my initial conditions. Which one do I want to go to? Nothing has turned up there so far. Now if I say, well, let's actually look at lending, I'm going to type create loan and money, which is what, notice what's happened there? Do not type the ampersand key at the moment. It's a bug, because that's just a reserved character in what's called Latex, which was the language we designed. I've got to type the word and. So create loans and money. I want to type, if I type create and underscore F here, notice I've got assets minus liabilities minus equity is now create F. It's got to be 0. So I've got to type a matching entry here. So since I've increased the assets, I've also increased the liabilities, and now Minsky says, okay, the row sums to 0, that's okay. So I haven't got the create F there. It says it's not correct. Okay. When I put the F on, exactly the same term, it's now correct. So that's creating money. Let's just make this window a bit larger. Now notice what's happened over here. That entry's turned up on the right-hand side, the left-hand side, pardon me, the banking icon. So the flows come in here, the assets come out the bottom. Let's create loan. Now let's have pay interest, where you pay money. Money comes out of the firm's account and goes to the bank's benefit. You'll ultimately repay the loan, but I'm leaving out some mechanics here at the moment. So you're going to repay the loan. That's so money comes out of the firm's deposit account, and the amount that comes out is also taken off the debt. Another 0. You then hire workers. Well, to hire workers, you've got to pay wages. So wages minus wages comes out of there, and plus wages goes in here. And that's okay because it's from one reserve account to another, a liability account to another. And then have consumption by workers. That's probably. So I'm going to have money coming out of here, so I'm minus. I'll use minus cons for shorthand for consumption underscore W for workers, and that turns up as money in the firm's account, and therefore consumption by bankers. So that's going to be over here, money comes out of here, cons underscore B, and that goes to the firm's account, cons. Yeah, sorry. That's fine. Yeah, thanks for letting me know. Okay. I'll put this up on YouTube at some point. Okay. Now, I've made a mistake there. Notice I typed a P rather than an O. Okay, so just go back and delete the 0, the P, and make it a 0. And that's the O. Did that make all make sense? Easy enough to follow? Okay. Now what you've got, and I just can shut that down, just shut it down, records all the info. So all those entries are now shown on this banking icon. There's create, the creation of money and debt, interest payments by the firm, repayment, wages, consumption by the workers, consumption by bankers. There are the 5 bank accounts. And at the moment there's no data inside there, but you've actually designed all these equations. Those are what are called differential equations. And I know they're consistent. I know that they're logically correct. This is what's called stock flow consistent modelling. Okay, I've got flows which change the level of stocks, and there's completely internal consistency. So in future years you'll hear about what's called stock flow consistent modelling. This is a sophisticated but simple way of doing it. And once I've done it, what I need to do is define all these. Okay. And there's many computer programs that will do this, by the way. This is the best. It's the most sophisticated, but there are other programs. People use things like a program called R. Build a similar stock flow consistent modelling in R. Others who use MATLAB. They've got to work a lot harder than I do. Now, on the menu, I can right-click, and one of the options I get is copy the stock variables and copy the flow variables. So if I click on that one, copy the flow variables, I'm going to copy all of these here in one block. And if I do the same thing over here, copy the stock variables, I copy all this lot. Now they're inside what we call groups, and that's this little box here. I could leave them inside there, but I want to actually look at them. So if I right click on the block, one of the options I get is ungroup, which takes them out of the group, shows them on the canvas. And I'll do the same over here. Now what I've got here, you can see a whole lot of elements over here, and notice on interest, which I've clicked on before I got to here, there are 2 little circles. That means there can be inputs to determine what interest payments are, and interest payments can go somewhere else. Now over here on these ones, if I click on loans, for example, there's only a dot on one side. I've lost the dot. Let's see if I can bring it back. Yeah, there's the dot. That means the definition of loans is occurring over here, and there can be no input to it because you're already defining it over here. Okay, that's the logic there. So here's interest payments. You click and drag them around, put them wherever you like. And here's loans. So what I want to have is a simple equation like I showed you a moment ago. The rate of interest times loans gives you interest payments. So I'm going to type rate of interest on loans here. So I'm going to use little r, and as soon as I type any character at all, a little box pops up on the screen where I can type fairly complicated expression. So I'm going to do a bit more complicated here and put ra underscore curly brackets loans. I'm going to be really complicated. F. Now this is using a formatting program called Latex. I don't know if any of you, don't suppose any of you know of it, but it's a way of formatting equations. It's a way of describing equations in text as an equation. So what this is saying is have a little letter R, have loans as a subscript, and then have a superscript of F. So it's going to click on the OK button. That pops up there, down here, and I get this window here where I can define what it is. So I'm going to define it first of all as a parameter. I can make it something which, if it's a flow, it's defined by other things, or I can just give it a value. If it's a parameter, I've set its value and I can vary it, but nothing else can help define it. So just for sake of completeness, I'll make it a parameter. I'll give it a value of 0.04, so 4% rate of interest, a maximum of, say, 20%, which is 0.2, a minimum of, say, 0.2, and a step size of 0.01. Okay. Click on OK. Now notice that it's turned blue because that's how we indicate things are a parameter. If I click on it, there's an arrow, dot going out but no dot going in, which means I can attach it to something else to make an equation, but I can't redefine it from the other side. So I bring it up here. Now obviously the formula is rate of interest on loans times loans equals interest payments. So I type a multiply key. If I simply press the multiply key, I get this symbol turning up on screen. And then notice the dot. If I drag from the dot and I go in the right direction, I don't have to go all the way there. If I release it, it finds the nearest input circle. And I've now defined an equation. I can move the bits and pieces around, which says the rate of interest on loans multiplied by loans equals interest payments. Now I haven't got enough time to go through to find the whole model, but if we go across to the equations tab, you'll see there's the definition. Interest paid by the firms is equal to loans to the firms multiplied by the rate of interest on loans charged to firms. Okay. So having done that, I'll just save that as a demo here. I won't finish saving because I just haven't got enough time to finish doing the whole thing. But once I've done that, in this particular model you can see here, I've defined all those elements. So I've got the rate of interest on loans as I've shown you, but I've got lending, actual lending. I'm saying it's the existing level of loans divided by a number showing how many years it would take for the loans to double, which I've got, say, if they loan at a constant rate, they'll double over 7 years. I've got repayment at the same rate. I've got workers consuming on a weekly basis, virtual less than weekly, bankers consuming over 3 years, etc., etc. I'm defining GDP here and profit and wages, etc., etc. I'm defining money as adding together the money in the deposit accounts of the public and the net worth of the bank, etc., etc. And up here I've got the controls, and I can vary the numbers there as I run the simulation. So if I start running a simulation here, I've got constant bank accounts, constant incomes, and so on. But if the rate of lending increases, so I make this, say, 6 rather than 7, so every 6 years loans double rather than 7, then bank accounts increase and so do incomes. And if I then have people repaying debt more rapidly, then I can have a slump in the economy. So ups and downs to the amount of lending and the amount of repayment, money in the economy, causes the economy to expand and contract. Okay, and this is the inherently simple point I've been trying to get through to mainstream economists for 40 years, and they haven't learned it. They refuse to learn this way of thinking. But what we're trying to do at Kingston is to expose you to the real world. And you can actually model the real world. You don't have to make the crazy assumptions they make to avoid thinking about the real world. So that's the basic thing I've built there. I want to finish off very quickly is talking about what they call unconventional monetary policies. And you can model this in Minsky as well. I've already done it, but I don't have time in this lecture to show it to you. Quantitative easing, well, that's purchasing. That's what they're doing, and they have been doing in Britain now for about almost 10 years, certainly 8 years. And what they've been doing every year, they've been buying £200 billion worth of bonds, more than they sell back. They buy and sell all the time. So over a year, they're spending £200 billion more buying bonds off the private banking sector than they're selling to them. Now, that's £200 billion a year of new money being created in the financial sector. Did you pay any taxes for it? Not a cent, okay? It's money the government can automatically create, and it's limitless capacity to do that. So they do two types of QE. There's QE with banks only, which I think is the American case. QE with non-bank financial institutions as well. So they'll borrow insurance companies and pension funds and stuff like that. And the intention was twofold. They thought they'd increase lending. Now I've shown you that can't happen. Okay? Because they're putting more reserves does not mean anything about lending. It's irrelevant. And banks aren't having a high liquidity preference by hanging on the reserves. They can only get rid of reserves in two ways. Either the government takes the reserves off them by selling bonds back to them and taking money back for it, or the public takes money out in cash. Okay? Otherwise, the reserves go from one bank to another. You can't get rid of them. So that is simply conventional economics. This is frankly stupid. Okay? I could think of a more polite word, but I'll live with stupid for the moment. What they have done is reduce interest rates, okay, to some extent. And they have also encouraged banks to buy risky assets, because if the banks sell £200 billion worth of bonds, which are fairly safe assets, particularly government bonds, they sell, if they're selling £200 billion each year to the government, central bank, then they're getting £200 billion each year as cash. Now they're trying to make money out of their money, so what do? They buy other assets, and they'll buy shares. And that's going to drive share prices up. Who benefits from higher share prices? Anybody in this room? No. What if I was asking at Oxford or Cambridge? Yes. Okay. It's the wealthy who get those shares. And that's supposed to increase consumer spending via a wealth effect. That's one of the things they thought would happen. Now, that just doesn't happen. And I'm being a bit facetious. Any of you fans of South Park here? There's a famous episode where I think the gremlins decide they're going to collect underpants. They're not certain what happens in phase 2, and phase 3 is profit. Okay? Well, sorry, that's not what the Bank of England said. They said this. They said, first of all, they'll purchase assets. That's going to increase confidence. That'll signal our policy is stimulating. That will cause banks to do portfolio rebalancing. That will increase market liquidity. This policy signalling and portfolio rebalancing will cause asset prices and the exchange rate to change, drive up asset prices, drive down the exchange rate. That will increase total wealth. It will also reduce the cost of borrowing. That will cause more spending and more income, and that'll return inflation to 2%. And down here as well, because they're purchasing assets, they will create more money, which will create more bank lending, which will also cause more spending and income, which will cause inflation to get to 2%. Okay? Well, this doesn't work, as I've just shown you. Okay? This doesn't work with shares. There's been research by the Federal Reserve which shows there is no wealth effect measurable in terms of aggregate effect on consumption of higher share prices. There is of higher house prices, but not of higher share prices. So that's wrong. And they've been doing this for 10 years. And what's probably returned inflation to above 2% now is Brexit. Okay, because that's caused the exchange rate to go down, so imported prices has rise. That hasn't worked either. So maybe my first diagram is more accurate. Okay, they don't really know what they're doing. The basic effects is you've been selling an income-earning asset, so the banks themselves have an asset which earns income. The bonds, they sell it to the central bank. They get a non-income earning one of cash, and they have a motivation to buy income earning assets like shares and commercial bonds. So basically they buy shares, but that then means ultimately they might get an increase in share prices. They might put some of that money into the real world, but more likely to put it back into the financial sector again. It can cause higher asset prices, and certainly asset prices rise, so a huge part of the increase in share prices has been caused by this mechanism, and it's no surprise that share prices are falling now because they're trying to do the same thing in reverse. Well, it's going to cause prices to fall. So overall it's had a very big impact on the financial sector, which is why the banks and the traders have been so happy about rising share prices. It's made the wealthy wealthier. It hasn't screwed the working class, but it's had a very small, slightly positive impact on us through maybe some of the spending out of people purchasing assets and brokers hiring more cleaners and secretaries and so on. a bit of it turning up, but it's only a fraction of the money that they've created. Like they're creating £200 billion a year, maybe 20 billion of that has made it into the real economy, if we're lucky. So that's the actual situation of banking and monetary policy. And I will see you next week. Do I see you next week or not? Not next week. That's cool. Okay. See you soon. I've got one more lecture with you about rethinking economics. I think the rest of the time is going to be seminars. Okay? Right. Yes.